Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading reports for April 17th, 2016. Market remains in bullish normal conditions. On an annual basis, using weekly RSI 14, we're at the higher end of neutral with 59 out of 100. The 10-day NDX shows us overbought at 85 out of 100. Market mosaic, price with respect to the 200-day moving average is green bullish at 4.12%. Slope of the 50s remains strong at 0.83% green bullish. ADX moved back above 15. It's neutral, but the trend is no longer weak. Excuse me. And we have bulls in charge. The risk index is the 30-period moving average of the VIX divided by the 10. 1.0 is the boundary between risk on and risk off. It currently reads 1.031, so we are in risk on conditions. We compare that score to the last 5,000 trading days, find the average and the standard deviation to produce the risk Z. That's how many standard deviations above or below the long-term average the current risk index is. It's reading 0.27. So you can see a 30-day. Slow down, Kenneth. You can see a 90-day histogram of that indicator here with a swing low, a higher low, and then a positive move to 2.3, which has decayed here as the market has gone sideways and a little bit choppy, but it's holding above the zero line, and we'll see where we are this week. Now, in this condition, when it's declining from very high levels, doesn't mean the market is failing. It just means that it's a cooling off period as the market digests all of the gains that were made on the front side of that slope. So this is an area in which we protect our profits. We are very careful with our rules about entering new positions. We're concerned about portfolio heat, and we're aware of the fact that it's been 40 days since we've had any significant volatility type event to shock the market, and so when those volatility events occur is when you see that kind of spike downward. So as we're getting close to the zero line, we're careful about that. So these are the current holdings for blended monthly rebalancing, and the next reevaluation is due on or about 1 May. These are the current holdings, or these would be the current signals based on Friday's prices for these different portfolios. In ETF2, we're adding a second position to XLP based on money management and performance, and a desire to emphasize conservative growth when the market is in this kind of a condition here. There were other higher speed, exceptional growth candidates, but my concern at this point was of the run being done, and I didn't want to expose us to additional risk. So that's why XLP, which is one of the strongest of the conservative U.S. Sector spiders and has been doing really well, and we already have a position in, so it's easier to manage. So the theoretical exposure will be 100% in the allocation model and in the model portfolio. These are the performances of the different blended monthly rebalancing portfolios. You see Latin America and Brazil have moved to the top of the stack with some exceptional performances here. Australia, on the back of really outstanding performance in metals, mining, basic materials. You'll see that down here reflected in XLI and XLB, and the industrial and the basic materials spider. XLP here you see in third position or fourth position after energy and tech. So good solid performances in here with plus a little dividend. At the bottom of the stacks, Japan, globals, US tech and small caps, and the US large caps. In ETF Max, we're looking at those top 40 symbols based on blended performance over the last 6 months out of a population of about 1,000 ETFs. Gold and the miners remaining at the top. Metals and mining has just been on a tear. and that's an area where I'm doing turbo trading intraday as well as longer term trading. Brazil, various forms of Brazil looking pretty good across the board. Canada moving to the top. And some momentum possible down here in energy with a 9% gain last week. In the S&P 500, Freeport Moran, on the basis of strength in the basic materials, Newmont Mining, however, took a bit of a plunge. Now that's a case where is a pair trade possible or excessive momentum? Probably both of those have overreacted. Southwestern Energy turning in a remarkable 1 week performance. Range Resources, Murphy Oil. Caterpillar in the Dow 30, offering some opportunities for some long side trading. In the market health check, the vertical blue lines represent 10, 20, and 30 days of look back. Purple line, we're approaching the swing high from last year, and the horizontal red lines represent support levels that were once resistance levels. You can see the slope of the 10 period regression line is up, the 30 is up. We're at the higher end in the upper half of each one, but not exceptionally so. So there's an interesting challenge of the new swing high here. This week is due, but the downside support level at 202, and then the 200-day moving average here at the edge of red around 200. You can see the slope of the 30-period regression line is this sine wave that bottomed out here at the end of January and has moved across the zero line and went positive here at the end of February and has been favorable ever since, peaking back here end of March 21st or so, and then has decayed a little bit here as the market has gone through this process of digesting, but it's had almost 20 days to fail further back through this level of 202, and it hasn't, and I take that as a favorable sign. And then we get the first inclinations of some buying pressure again here the Wednesday, Thursday, and Friday. So we'll see. Are we stuck in this trading range between 185 and 210, or is this really was this the pause that refreshed and allowed another breakthrough to the upside? We shall see. Percent price oscillator is basically neutral because it has been such a digesting market here that not much to choose from. We remain overbought here on Williams percent R. In ETF2, all 10 indexes now are on buy signals. That moves us up to 100% invested, 0% cash from a posture of 90 and 10 last week. That's what triggers the buy in XLP. The U.S. at 37 is better than the globals at 34. Inside the U.S., it's large caps, and then by tiebreakers, it's the S&P, tech, and then small caps. Latin America and Asia less Japan are the two strongest sectors. Japan and then European 350 are the weakest. Inside the sector spiders, there's strength here in the middle, XLU, XLP, XLK. World market model, most of the U.S. is above average. Japan is below average. The rest of Asia is above average. Strength in Malaysia. Only weakness we see is Hong Kong, India, Vietnam. Otherwise, it's above average. Latin America and Brazil continuing to dominate. Mexico, emerging markets, Canada, all doing very well. Starting to see some weakness now creep into treasuries and corporate bonds, private equity, as the market refused to fail last week, and maybe some equities are in play. All of Europe remains weak. We're seeing the same patterns in ETF 30 as we saw in the blended monthly. Miners and metal, gold mining, Brazil all at the top, along with Latin America. And then these that are green and white showing some strength Russia, South Africa, Canada, Malaysia. If it's white and then green in the strength and consistency, that's one that was at the top and now is starting to weaken a little bit faster than these front runners, and that would be the utilities, Alphadex, dividend portfolio, and the S&P dividends. So perhaps a change in regime here. Among the Dow 30, we're down to just two in the red: American Express, Goldman Sachs. CAT, 3M, United Tech, DuPont, all near the top. Caterpillar, again, just has been exceptional. Lots of weakness rotating out of, strength is rolling out of Verizon, McDonald's, Chevron, Walmart. They've all been on a really good tear, and maybe it's time for the new leaders to begin to emerge. That's what I'm seeing. Liquidity, just for your reference. Shifting to the daily. You see some signals on the Euro-Asia blend, and then Europe. Again, these are on the short side trades. I would only take these as targets if I see corresponding weakness in the S&P. It's been on such a nice run here that I'm reluctant to just blindly short. I want to see some intraday evidence that it's failing faster than the market, then I'll pile on. And then try to preserve some of the intraday position for an overnight position according to swing trade rules. You can see down here the bulls jump back and charge and turn the trending around a little bit. Still at the lower end of normal volatility here, just a hair above quiet. That's favorable for the long term. Although I must say it does set up the possibility of surprise for a volatility event. Half a dozen dojis in the Dow, channeling for Verizon and Intel, and then triple screen and 551W for Coca-Cola. Lots of frogs to choose from. Fewer dojis in the ETFs, a lot more of the short side trades for overreaction. 5-day down in the VIX, 551W and a max pain in XLP. VIX with the 4-to-1 reward to risk ratio, and the auto framer gold with a 2-to-1. Only the VIX is on single digits for RSI2. So this is a scenario that really does favor the long side. Here's some auto framer framing data and the RLFF usual suspects. Lots of daily pops to choose from here, the daily squeezes. What's interesting is that the S&P and EFA and IWM are all, and DIA to that matter, are all up here at the top. And what that means is that's a broad market phenomenon, that there was just not much price action happening. Friday was exceptionally quiet, and guys are willing to hold those positions over the weekend. And compared to the size of the normal daily moves, if you're simply using range risk, you're getting really favorable reward to risk ratios. You don't have to try to get that stop too narrow. Lots of goodies to choose from here. Prices move back above the regression line, and the polynomial regression line has started to curl back upwards again. We are still in the downward slope of the decaying portion of the RL30 slope, but you can see it has started to turn and go flat. It's stopped to fail further, and we've got just peaked above the previous cluster of highs here in the percent stretch versus the 200-day moving average. So that's promising. I mean, this is where it could have, should have failed, and it didn't. I mean, instead we got a gap up and solid closes on Thursday and Friday. Let's see what we get. And the z-scores are the regression line slopes and the price relative to the river. I like that it held here. The last time that it was here, it failed to the downside, which would be around 203, and couldn't hold and then failed. This is one that tested and regained. The last time was really here. Tested, held, gained. Tested, held. The first set of gains are in. Frogs. Holding periods. Intraday ranges. And SQN reports. Right, that's everything I want to cover for this weekend. This is Ken Long at Tortoise Capital. Keep your risk measured and your powder dry.